Alrighty, right at one after the hour. Let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours, and great to be back this week as we skipped last week. So excited to get into this session. First and foremost, as always, we have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, the market has reached resistance, and do we test the triangle breakout? Paul Tudor Jones tends to think that and more, and I'm interested to hear what Rob has to say. So, Rob, you out there?
I am Zach. How are you? Welcome to this week's Trade Finder, everyone. And Zach, I missed you last week. I was off on a vacation, fun trip, but not able to work out the timing for Trade Finder. And we know that there's issues on cruise ships with internet. We've had that problem before. So glad to be back with everybody this week. Let's get you caught up on what's going on. Let me get my video screen going. You can see
There we
back
go.
in the new Dragon capsule, if you will. So we'll move on from there. Taking a look at the chart of the S&P, there's the resistance line Zach was talking about on the breakout from the triangle. So we moved up. Now, we haven't fully reached the maximum point of the breakout, which is where you measure the width of the triangle or the mouth of the triangle from the high to the low. And then you go from the point of the triangle either to the upside or the downside. And we did have a pretty nice breakout, but again, we haven't fully reached the potential of the breakout, but we've been turned back a little bit as we near that resistance point. And that's the question that we're looking at right now. Do we stop around here, around this 570 to 575 range, and head back down towards the point of the triangle? As you know, when triangles break out, they come back to the point of the triangle. And same thing with gaps. You don't know exactly when that's going to occur. It can occur soon, right away, or it can take some time to get there. But your comments about Paul Tudor Jones, Zach, he was on CNBC this morning, and he thinks the market will make new lows. So he doesn't feel like this low is in. And his rationale for that is we're on this pause of tariffs, but once the tariffs are reenacted, and he feels that even if he does 50% on China, that's still going to slow growth. There's been a lot of commentary about what we've been talking about regarding the fact that yes, he wants to bring manufacturing back to the U.S., but that takes time. You can't just build factories overnight. The benefits from that, where he did say, yes, I do think the U.S. Economy will benefit from it, but it's well down the road before that occurs. And I think that's just common sense. I think most people feel the same way. Let's look at the moving averages. Now, the positive, if you're still quite bullish, is that we did get a little bit above the 10-day moving average. And even with today's little bit of a drawdown, at least for now, it's trying to bounce. Just had President Trump doing a press conference talking about how he wants to protect the U.S. automotive industry. That's why he said that he wants companies to manufacture their cars in the U.S. We are still above both the 10 and the 50-day moving averages, even with today's pullback. So although it may feel like there's some weakness in the markets, started near the close yesterday and then following through today. Really, all we've done is correct slightly overbought conditions. So we can't say yet, at least in my opinion, that we are moving back down to test the point of the breakout. We could break above this 575 level, satisfy the full movement of this triangle, and then perhaps at some point after that, we have another movement to the downside. Another thing that he cited is there's no motivation for the Fed to cut rates. We had mixed economic data last week where we had the GDP report come in showing a negative 0.3. The definition of a recession is two consecutive quarters of negative GDP. S&P. That's halfway there. We would still need another one, although there's a lot of people on the financial networks this morning thinking that when the revisions come in, and they revise these numbers 1,000 times, obviously an exaggeration, but they go through multiple revisions, that it will be revised back positive. So we'll see how all that plays out over the coming months, really. So that's going to take some time as well. So that makes trading in the shorter term a little bit trickier as far as where we go. So if you're wondering, okay, well, what would the expected breakout be? That'd be a great question. So we take a look here at the upper end of this triangle. We'll call that 550. Then in the lower end, 475. So roughly a 75 point mouth of the triangle. Call the point 525 to the upside. 75 points would bring us to 600, which is where I think we would go. If we break 575, I think we go back to all of this congestion that started at the end of last year and the beginning of this year. So I think 600 makes a lot of sense. This is really too much to be a false breakout, but I'm going to throw the scenario out there anyway. Or we turn and head back down. This was a false breakout, and then we move down towards this 475 level, which would be 75 points, or that's 50 points. So we'd be down towards the middle of this tap box, 450 on the downside. Let's take a look at the bond market and see if that gives us any sort of a cue. This 5-wave to the downside pattern is still technically qualified because it's at 73%. It's below the 78.6% level. Those are the rules within Elliott Wave. Elliott's guidelines were he felt like if you pass 70%, there's a likelihood that the pattern will be disqualified. But he still kept the rule-based 5-wave pattern all the way to the 78.6% corrective level. So that's kind of interesting. Let's look at the TLT real quick. That's been acting a little interesting of late. And there's two scenarios that you could look at with the fact that we are moving down in the TLT. Now, remember, TLT is the 20-year. I know a lot of you have heard this numerous times, but we had people all the time. The TLT is prices on the 20-year. We'll look at the TNX as well, which is yields on the 10-year. So prices and yields move inversely. So if prices are coming down, that means yields and rates are going up. Now, in one scenario, that's bad. That's viewing the recessionary risk. That's viewing the Fed sitting on their hands and not acting soon enough. A lot of negative connotations along those lines, especially with the US dollar, et cetera. But the positive scenario, if you want to spend things positively, is that perhaps money ran into the bond market as prices ran up to go hide with all the tariff talk, et cetera. And now money is coming back out of the bond market and getting ready to go to work in the equities market. So that would indicate some selling in the bond market as well. You put funds in the bond market to park them short term, and then when you're ready, you take it back out and allocate it into the equities market. That's a possibility as well. Regardless, we're getting a little below the 10-day moving average, so a little bit oversold on the 20-year. Maybe we get a little bit of a bounce, get a little relief in the pricing on bonds, interest rates, etc. Now let's go take a look at the TNX, and you'll see the opposite there. That one's going up. That's because rates on the 10-year are moving up. And you can see that although rates are moving up on the 10-year, not quite to the same degree as the long end of the curve or the longer end of the curve. So rates are moving up on the longer end of the curve. And there's another argument there that that's creating a more normalized yield curve where you're supposed to earn higher interest for holding bonds longer. The inverted yield curve is when things are out of whack, where you're actually getting a greater return on shorter maturities. That's not how it's supposed to work. You're supposed to be rewarded for holding bonds and treasuries for a longer amount of time. So you can see there's a mixed bag. It's just depending on how you view things. There's arguments to be made either way. And when the market is like that, when it's kind of in between like that, it makes it challenging. It's just basically your personal view on where things are going to go. Let's take a look real quickly at the VIX, and then we'll move into other markets within the U.S., and then we'll get to the metals and also into the energy sector. Holding right here, we came down, we did break 30. We came down here at 22.5, which was resistance, as you know, at the beginning of the year on the VIX. And then we moved up to 30, came back down, tested 20 or 17.5. And then we had a big move up on the sell-off when all the tariffs were announced, et cetera. But holding back down here, still slightly elevated on the VIX. But certainly anything below 30 shows that the market has calmed down quite a bit. There's actually some commentary on the financial networks this morning that people seem to be relatively calm. There's a big investment conference going on right now, so lots of interviews are being had, and nobody seems to be sounding any sort of alarms anymore. The most bearish was Paul Tudor Jones talking about how he thinks that we may make new lows once that 90-day grace period ends and we start moving back into tariff talk again. But right now, 22.5. If we could break that, that would be a sign that we're likely to go to the upside in the equities markets. But we're trying to hold right here, at least today. But we are below the 10-day moving average, so you take that with a grain of salt. What we want to see is, do we bounce back to the upside off this 22.5 level, or do we break below it and head down to 17.5? So the VIX, I don't think, is quite the indicator to look at as it once was. I used to trade the VIX a long time ago when it was on the OEX instead of the SPX. And it was incredibly accurate, and I feel like it was so accurate they decided they needed to change it. So they changed the VIX to be on the S&P 500. Makes it far more difficult to trade, in my opinion. It's like they don't want trading to be easy. They want it to be difficult and challenging. Well, they certainly changed the way you could trade not just the VIX, but the equities markets based on the VIX, for sure. Let's take a look at the DIA. We'll come back and look at the dollar in a minute, because the dollar has been constructive and helpful. It stopped its massive sell-off. Here on the DIA, nearing a point of potential resistance there at 425. We'll see if that continues. Just kind of barely. This one could be more considered I'll take the AI off so you can see this. More consideration here on looking at a false breakout, because we barely broke out of the big triangle on the DIA and then reverted back down. If we were to close here, which we probably won't, but if we were to close here, we would have a doji on the charts today. We'll see how that works out at the close of trade today. So for now, we just have to wait and see what happens. There is an opportunity because it's such a shallow breakout, one could argue that, well, you just move that upper trend line there. It does take you away from this high back here that occurred in early April. So I'm going to leave my triangle right here. And I've commented on this before. Sometimes people make comments on the YouTube U.S. market updates that, oh, I don't agree with where your trend lines are, et cetera. I'm really not that concerned with drawing exact trend lines on triangles. I just want to know from a general standpoint if we're in consolidation. So you could argue we're exactly where the trend lines should be drawn. I like to draw them where we have the most touches on the line. That's why I have that lower trend line of higher lows there. But that's a large triangle on the Dow. There is going to be some sort of a significant breakout on the Dow. And again, with just this shallow move, we could say that there is a potential for that yielding a false breakout. Looking at the Qs, if we take a look here, pardon me, you'll see that very similar to the SPY, where we're nearing a point of resistance there around 500 is the key level on the Qs. A little more of a breakout there. It would look like the false breakout was to the downside on the Qs, and then moving back higher here an area near that 78.6% level. So these Elliott Wave patterns here on the Qs and the SPY are in a proximity where a relabeling could occur. A little bit of a move back down. And I would say, in my opinion, that the Qs have acted pretty well over the past couple of trading days, considering rates moving up. I wouldn't have been surprised to see the Qs have a little bit more of a corrective move. That could be an argument that perhaps the reason that prices on bonds are going down and yields are going up is money's moving into equities. There's been a bid under some of those Mag 7 stocks, not across the board, but some. So there's certainly some nibbling on the corrective moves there. And we are still above the 10 and 50-day moving averages. Note the positive cross here between the 10 and 30-day moving averages on the Qs. And that could tell you that the 50-day is about to turn and move back to the upside, but actually do it first. But that's an early indication. Most people, if you're not familiar with what I'm talking about, view the 50-day moving average as the intermediate trend indicator. But you get an earlier signal based on crosses between the 10 and the 30. So if the 10 crosses below the 30, then perhaps we have the potential of starting a downward trend. If the 10 crosses above the 30, then perhaps we're looking to move back to the upper side, an upper trend, if you will. And I was taught that way back when I first started from ex-market makers that said that was something that the floor traders look at, those 10-30 crosses, which is why that's on my screen. Now let's take a look at the IWM, very rate sensitive. We did do well on this on our case studies. In fact, our past couple of case studies here at TradeFinder were very profitable, nicely worked out very well, I'm trying to say. But you would expect to see a little bit of a tick down on the IWM as it's even more rate sensitive, probably the most rate sensitive of any of the markets than even the Qs. Only a 40% wave 4 correction, but we did get a pretty nice breakout. That one's more in the area of what you would expect from the width of the mouth of the triangle, so that actually could be a completed breakout move. And then settling back down. We are below the 50-day moving average on the IWM, still above the 10, but just barely. So if we are going to get a continued period of rates moving back to the upside, I think the IWM is susceptible for moving back down. And I would tend to agree with Paul Tudor Jones that maybe a test of the lows, if not new lows, would be appropriate on the IWM. But again, we're not there yet. And the first step would be test the point of the breakout before we start talking about new lows. That could be all that's going on here. So we had a little bit of a bounce in the markets, and now we're kind of going a little bit sideways. I said it would show the dollar, and it stopped its sell-off, but we've been trading sideways here and bumping our heads against 100. I'd like to see it get back above there. You know, if you've been watching, my sweet spot is around 100 to 105. That's where I'd like to see us, 104, call it, on the dollar. I know that's a confined range. It's a pretty tight range, and it's very much a Goldilocks scenario, but I think that's where the dollar is showing that there's still faith in it, with other countries being the currency of last resort, and yet it's not so high that it's causing extreme problems with the exchange rate and going right to the bottom line of companies that trade internationally when they report their earnings. So this was concerning how fast we moved down through here, but holding and bouncing back to the upside is constructive on the dollar. But so far, we're just testing what was support in that 100 range is now resistance. I would like to see the dollar get back above 100, just not significantly so. So I know that's really picky in general terms. In summary, I think the dollar is constructive as far as the equities market having the potential to move higher if that's what's in store. Now let's go to the metals, and gold is just on another run. Amazing what's going on with gold here, and you could make a number of arguments over why. Fear, being concerned about the tariffs and the effect on the economy, worries about recessions, etc. The one thing that's, or actually there's two that really haven't played into this next move to the upside here, is the fact that rates are going up. Usually you see GLD when you're worried about rates going to the downside. And then we also have the dollar. When the dollar sells off, the metals tend to go higher, and the dollar has been, as I just showed you, stable for the past couple of weeks. So pretty interesting here that we're getting another bounce to the upside. Certainly, this was too vertical of a move. Got a little too far from the 10-day moving average. We came back to the 10-day moving average. Been going sideways here. A little bit of a test. Was wondering if we might test the 50-day moving average, but we didn't make it that far down. And then gold's off and running once again. Really significant move higher. We're actually going to be doing an event with some people that are very astute, and we an event several months ago talking about the bullish case for gold, and it played out perfectly. So watch for some more information in this week's U.S. market update regarding that if you are interested in gold, something you would certainly want to attend. Silver, I've been waiting for silver to play catch up, as you know, with this big, huge triangle that we have here, trying to get a little bit of a breakout today. We'll see if that can continue. Silver just has been lumped in with the manufacturing side of things, with technology using so much silver, and that's been more of a an issue for silver than following along with the big rally in gold. But they don't separate like this for too long normally. So I do feel, especially if gold is going to continue with that bid underneath it, to have a continued move to the upside here. And at some point, it will have a outsized move to GLD so it can catch up and be in the same area of where GLD is. So watching silver very closely on these movements over the next few weeks. You can see that the consolidation was so long that we had the 10, 30, and 50-day moving averages all converge at the exact same spot, right at the point of the triangle. So this will be a big breakout in silver. We still don't know whether it will be to the upside or the downside. So we got to keep an eye on that. But some sort of a significant breakout is coming in silver. It certainly makes sense. The markets don't always do what makes sense, but it makes sense that perhaps breakout on silver is to the upside, and that's where it runs through that catch-up phase to catch up to the movements in gold. But you also have to respect that anytime there's a triangle, it can break either direction, and we may have a downward breakout in SLV as well. Looking at natural gas, UNG had a little bit of a movement back to the upside. We've been wondering if we were going to get, you see we have this potential here for a wave 5 impulsive move. The wave 4 just barely hanging on right at that 78.6% level. Also at the end of the extended C wave of this downward zigzag, it was a logical point for UNG to try to bounce, as well as having a support line going back down to end of last year. But we weren't able to get above the 50-day moving average, and we'll need to do that. A little bit of a movement down in natural gas right now. But still, at least at this point, we'll see where it closes, holding above the 10-day moving average. We'll see if that can break above it. Obviously, it's going to need to do that first before we start talking about completion of a wave 5. You know the story there on natural gas, that all the data centers that are going to be built, going to be using natural gas. But once again, the same argument of bringing manufacturing back to the U.S. How long does it take to build these data centers, and how much natural gas are they going to be using? There's been some rhetoric that kind of stopped this last upward movement in natural gas, that some companies, based on concerns over the tariffs, the economy, et cetera, maybe putting off plans to build those data centers, or maybe not build as many as was once thought about. So that sent this corrective move in the wave 4, and now we're trying to turn and move back to the wave 5. But once again, the thing to watch there, if you like natural gas, is it needs to get above that 50-day moving average. Looking at oil, and I can tell you from my travels, there are lots of vehicles on the highways, and I drive after market hours, usually in the evenings, so that there's no typically not nearly as much traffic. That didn't work out in these travels. The amount of cars on the road is phenomenal, and we talked about how, with oil moving down here towards the lower end of the range that I feel like is where we're going to spend most of the time throughout this year, people were saying, "Oh yeah, no, oil prices are going down, but I haven't seen it at the gas pumps." And we talked about that. When oil goes up, seems to be reflected at the pumps the next day. When oil goes down, it takes weeks before you start to see lower prices at the pumps. But they have come down a bit, and we're back below that 65 level. I don't think we're going to spend too much time here. I don't think OPEC is going to allow oil to go too low before they start cutting production. They're trying to manage this very carefully between the supply demand curve. They don't want to have oil prices go too high to where it pushes more people towards electric vehicles, but they also don't want it to go too low because they're trying to maximize the amount of money that they can make with the supplies that they have left in the ground. So I would be surprised to see oil break below 60. These lows set in April. Anything's possible. The market surprises me all the time, but I feel like maybe a little consolidation here and a little move back to the upside. But as we are starting to near the summer driving season, peak vacation times, it is nice to have just a little bit of a break at the gas pumps, at least. All right, let's take a look at a few international markets, and then we'll open it up to questions, and then we'll look at our case study for this week. Quickly, we'll take a look at Australia, which has had a nice move. We showed this yesterday to our subscribers at Ewo Trader. We had this really nice wave 4 correction right at the 78.6% level, right back to the point of this descending triangle. And is that the end of it? Is that all we were doing? Is going back up to test the point of the breakout, which we've done. We talked about that earlier. Or are we going to violate this 5-wave pattern? It will become disqualified. And then we have this being an impulsive move to the upside. Don't really know the answer to that question yet. People always ask, well, why does the algorithm, if the pattern's disqualified, still show the wave 4? Well, it's close enough to 78.6 that it's staying on there. And that's part of the reason in the algorithm, the way Elliott wrote it, that it would still hold this. Because remember, this software, hub.com, if you haven't gotten a copy of it, go get a copy of it. Free Elliott Wave is the fact that you can have slight, it's not spot on 78.6. You have to have a little bit of a margin of error there. But if you break that wave 1 low, then the pattern will go away and it officially disqualifies. But it's right in that danger zone of where this could move higher. But if all we're doing is testing the point of the breakout, we could reverse and start back down in a wave 5. I really thought that when we moved up from this 23 level up to 24, we might have a little more resistance there. Didn't happen, blew right through it, right up to the next level at 25 and the point of that triangle. Let's take a look at Canada. The Canadian market seems to just be not concerned at all with what's going on with the tariff talks. Maybe it'll be more affected when we start getting close to that 90-day grace period again. My opinion is I feel like part of that 90-day grace period was giving the administration time to work all these trade deals. And Trade Secretary says that deals are being hashed out and that we won't see that renewed hardline tariff talk that we saw earlier in the year there at the beginning of April. We'll just, again, have to wait and see how that plays out. But for now, the Canadian market is just been turning a blind eye to it and running through a nice rally, bit of a 45-degree angle back to the point of this triangle breakout. So it's tested that. And it's in an area now where, boy, something could really happen here because we're at the resistance levels going back to the end of last year. As you can see, if we could break above 43 on the EWC, could really be off and running on the Canadian market. But it's got to do it first. Again, the Missouri syndrome there show me it actually has to happen. We can talk about possibilities all we want, but it actually has to do it. And then across the pond, which is just laugh a little bit because this is just completely mind-boggling, still is. if you've looked at the economic data from Germany, does not warrant this kind of a rally. But the ECB has been very aggressive in cutting rates. They cut rates at their last meeting. Christine Lagarde said that she's open to cutting rates again if necessary. They're going to be data dependent. In the words of the Fed or any central bank loves to use, the ECB does it as well. And that's just gas on fire for equities markets, having rate cuts going into effect. And that's why our administration is trying to put pressure on the Fed to cut rates sooner rather than later. The debate right now is would the Fed cut in June or July? Nobody thinks May anymore, but back in this area, when we had this big move down in the U.S. markets, May was priced in pretty highly, and then that's gone away, and now looking more towards June. Maybe the Fed surprises us at the May meeting. We'll see. But right now, you can see right here that the wave 5 is extended almost 100%. Here you go, with the wave 4 right at the 78.6% level. It ticked above it just a hair, and that's why the wave 4 stayed on there, even though slightly violated 78.6 again, but very close, just by half a percentage point. 50 basis points was all. That yields the 100% extension. We're right in the middle of the tap box here, which is time and price projection on the wave 5s. So now we see, is there any further movement to the upside left? In the EWG, we are overbought from the 10-day moving average, so some sideways or backing and filling here seems to be warranted, but that market just boggles my mind every time I see it. Let's take a look at the Nifty for the market in India. See what's going on there over the last couple of weeks, and a renewed bid. We talked about the positive being that the wave 5 had ended, but it extended more than 100%. So we were only looking for a bounce back of 61.8%, which is what it hit immediately, bounced back down, but there's a trend line of making a higher low, and now we're breaking above here. So even though that isn't in the rules of Elliott Wave, the next level to look for would be wave 4. If the wave 5 extends less than 100%, you do look for a move back to wave 4. If it extends more than 100%, you look for a correction to 61.8. It's satisfied that, so it does seem like moving up here to the previous wave 4 is in the cards there. And hopefully you're noticing this, if you've watched enough, that there is a zigzag pattern there on the Nifty right here that we're continuing, and that could play out with that movement up towards 58, 59 area on the Nifty. Once we get there, then we'll have to take another hard look at what the next move might be. Let's take a look at China. We haven't looked at that one in the last couple of weeks either, and see what's going on there. And you can see that we're getting a positive breakout from this triangle here. We went sideways for quite some time here on the FXI, where all the moving averages converged again. So this is kind of that blast off pattern, the launch pad effect that we would talk about in the past. When something consolidates dead sideways, just a flat line consolidation, kind of like a launch pad. And then usually things take off. They can go either direction, but most often it's a breakout to the upside. That's the blast off from the launch pad. And that's a classic example of what we talk about when we say the launch pad effect. A really tight sideways consolidation. Usually you're getting ready to have a breakout move, and certainly worth taking a look at what's going on in China with the FXI on this upside breakout. Where could we go from here? We're just getting a bullish 1030 cross. We are a tiny bit overbought from the 10-day moving average, not hugely so, but I would think that this movement up towards 37.5 makes a lot of sense on the FXI, and then we'll see what happens once we reach that level. But I would be very surprised if we don't hit 37.5 on the FXI. So as I mentioned in our previous case study considerations, we had SMCI, which worked out extremely well on the bounce, and we posted the close of that just really spot on. So we were down here, support of 30, and we caught this bounce. That was a great case study there, and then boom, right back down. So we closed it out, even though we didn't quite make it up to the level that we had talked about a couple weeks ago, 42 and a half. It was a nice move, and you take those when you get them, especially when it's following a gap up, because if you're an options trader, you got a little extra IV in the call options, and that goes to more profits. We don't look at the options on the case study considerations here and the social aspect of this is Hub software, but that was a nice move, and we had posted the close of that. We had the IWMs bounce as well, which worked out extremely well. You can go to this. Zack is going to show you here in a few minutes how to post an idea, read other people's ideas, etc. So we had this nice bounce on the IWM. We hit our price target, and we took that one off. So we had the IWM going down and then turn around and coming back up. So we hit the IWM on both the sides there. So those were really great case study considerations, and we looked at T-Mobile before that. So we're on a nice run on profitable case study considerations here. We had a really big run for a long time last year, and we're back on that when we had caught this move here to the upside on T-Mobile. A little bit of a correction here as that got a little bit overbought sideways, and then the breakout of the triangle, and then coming back up to test it. Really difficult to see where we go from here on T-Mobile. But I got a little bit of a bonus for you on the case study consideration today. We look over at the AI signals, which is another feature of the software. Now, I mentioned you can go to hub.com if you haven't already and get the software for free, and it's free Elliott Wave. There is an aspect of having the AI signals if you would like those. This is what it looks like, what you see on your screen here. So you get them every single day. You get bullish, bearish, and now they've added in the wave 5 bullish signals, which the timing of the data scientists releasing that couldn't have been better. If the market has made the lows, you're going to find an awful lot of wave 5 bullish trades. That's when the wave 5 ends and you're moving back towards the previous wave 4 with a downward move. Could be quite a few of those. So the timing of the data scientists, the AI guys at Hub releasing that couldn't have been better. But I wanted to show you this one on NetEase. So you can see the score is 83. That's a high score. This is what the chart looks like. So this is just a preview. If you did become a subscriber to the AI, now the software is free. It is a subscription for the AI signals, just to be clear. But I really like this setup. You can see several things here that we have a major point of resistance there at 105. We've broken above that. We're getting good separation here from the 1030 crossover, going sideways a bit here. 84 is a pretty high score. There's no guarantees. Nothing's 100%, but that's a pretty high score. And the AI is given a target price of 116.75 on where things could go. I still like to look at the DMI, even with 300 plus data points that the AI looks at. And you can see the ADX is crossing above 20 there, separation between the two directional indicators above the negative directional indicator. So the DMI is supportive of a continued move higher. Look at the CCI, and that's just kind of flatlining around the positive 100. The CCI stays between positive 100 and negative 100 normally, but when it moves in an outsized move above 100 or below negative 100, the software's version of the CCI gives you this shadowing. So it immediately draws your attention to outside move, which I think is really cool. Kind of call that a neutral to bullish scenario on the CCI. What we wouldn't want to see if we were wanting to see NetEase continue higher, which we are, we wouldn't want to see peaks like this because those are extreme point highs, and that's usually telling you from the CCI that you're overbought and perhaps a little bit of correction, sideways backing and filling at least are due, but we don't have that signal on there. So this looks pretty good. So NetEase, symbol NTES, trading, call it 110, and moving up to, we'll just say 115. So we'll stay even below where the AI signal is. So NetEase moving from here to 115 is going to be our case study consideration for today. Again, a bonus one showing you the results of the AI. Don't do that every time. So don't think, oh, I just need to show up a TradeFinder and I get those signals. No, not how it works. Just kind of wanted to give you a preview of it because I really like the setup on this one. All right, so with that, Zach, happy to take a few questions before you come back and show the folks how to post an idea. And that one will be a actual idea since it's from the AI, not just a post.
Very well. Sounds great, Rob. Let's get right into it. Got a question on HIMS, HIMS.
Yeah, let's take a look. I haven't looked at that chart recently, so let's take a quick look and see what it looks like. Boy, that's a big move. I don't know if that was on earnings or not. Perhaps that was an earnings report to generate a bid like that in the market. So we moved to the upside, had just one consolidation day, and then moved higher from here. This is another thing about the AI signals. This AI is showing a potential sideways movement following a big drop. So HIMS had a big drop, and then it gets a score on a potential sideways movement. You can see it's red because the score was very low. So there is a way that you can play the opposite of the signals. So basically, you're fading the signals, if you will. And on these sideways drop ones, fading this signal means that it's not likely to stay in a trading range. It's likely to break out, which is exactly what's happened with him. So a low score means on a potential sideways means it's likely not to stay sideways. So here's the breakout. And on the movement today, we're a little bit above that 10-day moving average. Again, I don't know if this was earnings last night or before the market this morning, but nice move there to the upside. And obviously the question that's being asked is where do we go from here? Perhaps a little bit of resistance here at 50. The problem is we got really vertical when we broke above that in February. But at this point in time, we're breaking above this congestion line. So what you want to watch on this is where does it close today? Can we close above this area right here where we had some congestion in February and the end of February and early March? So that's encouraging that we're at least trading above that right now, but you want to see the close there. And if so, then there's really nothing in the way for it to continue higher because this was so vertical in February that there's no point in resistance from it on the way up. So watch where the close is. Know that it's slightly overbought in today's trade, maybe a little bit of backing and filling. But if we can manage that close above this 45 area, then HIMS could go higher.
Very well. Next up, let's go over to IONQ.
Another one I haven't looked at in a while. So that's what I really like doing this show is because you guys come up with symbols that aren't, you know, we do have the old standbys, but come up with some that aren't typically ones that we look at every day. So in this, now this one was in the AI sideways search as well. The score was too low. It wasn't quite as low as the one that we saw prior on HIMS. So this one would be neutral. That's why it's colored gray. And the AI is like, it's not a high enough score to where we're confident it's going to stay in a trading range. And these boundaries are the trading range. It's one standard deviation above and one standard deviation below where the drop is. But there's a possibility that it breaks out. So interestingly, it went right to the boundary level and came back down, and we're sitting on top of the 10-day moving average. This one's a little more kind of old school. So the AI was a little non-committal here. Inconclusive, if you will. And then we have had this pattern here, and this is the old school, just a plain old trend line of higher lows. There is some resistance where we are right now, which coincided with that upper boundary from the AI. But you can see that we traded above it, came back below it, got above it, back to it, and then broke below it here in February, and now we're back up to it. So if you want to be long this stock, you want to see a clean break of 30. Let it break above that. It did that last week, but there was no follow through yesterday, and now a little bit of a pullback here. But again, the positive is that you have this trend line. So I guess I would say two things to watch. Number one, can it close above 30? And if so, then it's got some room to go. I would say 40 is easily within the cards if it breaks above 30 before we get to that next level of congestion. But the other thing is if we back off a little bit, can we hold that trend line of higher lows? So if it pulls back a little bit more, that's what you'll want to watch, and it kind of coincides with the 50-day moving average there. So a break below that would be quite negative. But again, it's got to do that. So for now, still holding the 10-day moving average, having a little trouble here with breaking through resistance at 30. That's why I say I would just wait and watch this one, see if it can break above 30. Then I think you have a good trade there. Breaking below the trend line would be a short position, in my opinion. So wait and see on IONQ right now.
Thanks, Rob. Got a question from Lisa here. Is there enough months with VG for Elliott Wave to be labeled, to label the waves yet, rather?
Well, let's take a look. Venture Global, certainly not with, I don't even know if there's 100 data points. You can change the data points. I use 377. That's in the Fibonacci summation series is one of the numbers. 300 is the standard that comes with the software. You can make that change by clicking on that cog as I just did. And periodically when there's not a pattern in the longer term data points, you can take a look at the shorter term, but yeah, not even enough data points or potentially no Elliott Wave pattern yet on VG. So unfortunately, and I think you surmise that and asking the question, is that not really any sort of Elliott Wave pattern to try to analyze here. I'd have to do some research on this and see if there's any investment companies that have invested here because it's trading below $10. You probably know the rules on, I've talked about them numerous times. Investment companies can trade or own stocks that are above $10 if their investment objective is growth. To get down below $10, single digits, between 5 and 10, their investment objective has to be aggressive growth. So with the opening way up in this area, and you all seen this, IPOs, et cetera, new securities trading tend to sell off as people take gains. Maybe that was higher than where they expected it to be. Hard to read this one. Again, I would have to do a little bit more. This looks like a spot here where there was some investment company ownership, and then when it broke below 10, they bailed on this big bar of selling here, and there hasn't been any sort of significant buying, just a little nibble right in here, and moving sideways since then. So you'd want to see what the ownership level looks like of VG. That's a little more difficult to call there.
Good old Palantir, PLTR.
Yeah, they actually had a pretty decent earnings report, although it wasn't blowout last night, and not being received so well by the street, so to speak. You can see the big move down, but then you can say, well, okay, but people bought in anticipation of that good earnings report, and maybe they were expecting some sort of a really blowout number, but it was positive to in line. Not bad by any way, shape, or form. We ran right up to that resistance at where the wave 3 high was in February. And then without the blowout number, we're getting a little bit of selling here. So the key will be, do we come back down and test 100 again on Palantir, or can we gather ourselves somewhere above that 100 level and take another run? For me, this range between 100 and 125 is kind of a no-go zone at this point. This run here, when it broke above 100, you can see that with this big drop, there was no resistance between 100 and 125. I think we talked about that in the past because there's no resistance when you have such a dramatic drop. So had no resistance to run back up, but it does have resistance at that wave 3 high. And then earnings last night were backing off just a little bit. So kind of no man's land right here. Um, Oftentimes, even on good earnings reports, profits are taken, and probably what was going on with those that were involved in this upward move. And then we'll have to let it play out. It may just stay in this range for a bit, but for me, I wouldn't want to do anything with Palantir right here unless it broke below 100 or above 125.
Thanks, Rob. Next up, we're going to go to Rivian, RIVN.
I haven't looked at that one in a while either. So nice looking cars, but let's see what the stock looks like. And nice little bounce there. In a large trading range here, though. You can see this support. There's that $10 that we were just talking about. So there are likely institutions that own this that supported it back down here and at the end of the year last year during the fall. And now we've got some resistance up in this area right through here. And if we can break above this level, it ran right up to it and backed off, but we're still above the 10-day moving average, and we do have the bullish cross. If we can break above this, call it 14 level here, and try to get up towards 15, it could take off. There's nothing. There's no resistance above it. That's the racing analogy of running out front because you're running in clean air, and your engine runs better rather than being in the middle of the pack and dealing with everybody's exhaust, etc. But it's got to do it. It's got to break it. It tried, and it got turned back, but it was a little bit above the 10-day moving average. And if you've heard me for a while, you know that I don't like to see resistance levels broken when you're already overbought because they tend not to hold. You want to see some consolidation right underneath this resistance line, a little bit of building of energy, and then break. And then we have a chance for it to take off and run. This one definitely bears watching to see if it can do that. Good watch list candidate here, I guess is what I'm trying to say. I don't have a read on doing anything at the moment, but certainly if it could break above the resistance line up towards 14, that could have some room to run higher.
Nvidia.
I haven't seen that one in the last couple of weeks either. So see what's up with Nvidia lately here. We had the triangle, and this is a case where the triangle actually took a little longer to form. If you look at the ADX, I've talked about this in the past. This is exactly why I like to see with triangles the ADX down below 15. And when the ADX is above 15, no matter how good the triangle looks, there's a potential, not always. Stocks break out of triangles with higher ADXs all the time, but there's a potential that even though it looks like a decent triangle, the triangle formation is not complete yet, and it's just going to form a larger one. And that's what's happened with Nvidia. So I'm going to go ahead and move that line down, and we're going to move our trend line this way to show that indeed we were building a larger triangle here on Nvidia. And that line is a little more difficult because I really like that one with the touches of the line. But moving up without breaking out, we'll draw it this way and split the difference. So basically, Nvidia is still in breakout mode, and it could move either direction from here on a breakout. The width of the mouth of the triangle is from 90 to 120, so it's a 30-point move on Nvidia that will be coming likely now in the not too distant future, because if you noticed on the ADX, it is diving down below 15 now. And basically what that means, the ADX measures the strength of a trend. So when the trend is trendless, the ADX confirms that. You're likely going through consolidation when the ADX gets down below 15. So that's exactly what's going on. Watch for a breakout, Nvidia. No idea which way it's going. I know that it looks like a wave 5 is finished, and we could break up to the wave 4 because the wave 5 was less than 100%. But Elliott was very cautious on don't get caught picking a direction of the breakout. Don't lean one way or the other. No matter what the other rest of the pattern looks like. A triangle can break either way. So I think we just watch Nvidia here, and when it breaks, jump on that trend, because it'll be a pretty significant move once it does break out.
Got a question if you see any count on Oracle, ORCL.
Let's take a look at Oracle. You need to spend some more money on their Formula One team, because they're not having good a year as they've had over the last few years. Them and Red Bull, they need to get their act together. Big Oracle Red Bull team fan. So above the 50-day moving average, nice move here off of the lows. You can see that even though the AI gave this one a low rating, it wasn't quite sure about this downside target. And you know it was a downside target because the target was green, the fail zone's red, and it went down there anyway and hit it. Even though the AI wasn't committed enough to give you a higher score. So we've gotten a nice bounce, a little bit of a gap up, holding the 50-day moving average. Little bit of resistance right where it is now at 150. Not real significant, but a little bit. If we could, I'd love to see it come down and fill this gap first. I hate the gaps, but if we could come down and fill this gap, hold the 10-day moving average, I would think that you could look long Oracle. If you want to be a little more conservative, I normally give aggressive and conservative stances. Everybody has their own risk tolerances. You know what yours are. If we break above 150, that would be a little bit more of a conservative weight to see if it can do that to go long. And if it does, then 170 should happen rather quickly, because this was a big move down from 170 to 150. So same scenario, no resistance in the way. We can move back up quicker. So the aggressive move, even the aggressive move, like to see coming down to fill this gap. It may not do that. Again, we don't know when gaps are going to get filled. We just know that 94% of them do get filled based on our AI data. It's not 100%. Doesn't mean all gaps get filled, but vast majority do, but it could be a while. So I may be getting a little too picky here, hoping that the gap gets filled on this before turning back to the upside. But nonetheless, regardless of whether it fills the gap or not, let's see if we can move back above 150. So if it comes down here, fills this gap, holds the 10-day moving average, and bounces from an aggressive standpoint, I think you could step in. Regardless of whether it fills the gap or not, then 150 would be your target.
All right, I'm going to sneak this last question in before heading over to the platform to post the idea or case study consideration for the week. Apple to continue lower.
Good old Apple, my least favorite stock to short on the planet, because they have so much cash and you never know when they're going to step in and initiate a stock buyback. Sometimes they announce it, sometimes they don't until afterwards. And that's what makes it so challenging. When you have a mountain of cash like Apple does, they can affect a downward move and create a short covering rally just with their own buying. But it is in a nicely structured wave 5 pattern to the downside. The AI had this coming down here to 176, even though it wasn't a high enough score to send out an alert once again. Even with the lower score, it still did it. But of course, that was during the period when everything in the market was moving down. We've moved back up here to the top of that A wave area. So that would have been the bottom of the A wave impulse in the zigzag pattern that played out right to the 100% extension. This is what you would expect. Now, if that zigzag is complete, which it clearly looks like it is, oftentimes you'll retrace the entire C wave. We didn't quite get there. That's at 225 on Apple. I would watch this area, but I don't think you can step in long on Apple when it's below the 10-day moving average, not when it's still a very well-constructed 5-wave pattern. The question here is, does the management at Apple let it come down that far before they start buying stock back? Maybe, maybe not. And, you have to be in their boardroom to know what the discussions are. And when they look to do that, how far will they let it go? I think that 200 is an area that they don't like seeing their stock price below 200. So I'm going to watch this very closely and see if we can hold this level and attempt another bounce. If not, and we start down, you have to respect this wave 5 pattern here. It's just there's always that caveat with Apple, no matter how great, and that is one of the more symmetrical, well-formed five-wave patterns than you could ask to see. It's as classic as it gets, which makes you think, yes, we're going down here. We're going to make a new low on Apple, and we're coming back down to $150, and it might do that. Again, you got to keep in the back of your mind, though, that they could come in and buy billions of dollars worth of stock and turn the whole thing around. Without that outlier, I would feel a lot more confident that Apple's going lower. So let's see how it handles this 200 level. And if it starts to break down from there, then I think you can short Apple. I do think it goes lower at that point.
Alrighty, thanks for your analysis there, Rob. I see we're a minute after time, so I'll quickly pivot over to the platform to post the idea for this week. And let me take the screen here. There we go. And this is going to be an official idea for this week. Is that correct, Rob?
That's correct.
So as we see over here, I'm going to go up to this light bulb for ideas, come over to this left toolbar to new idea and create an idea. This week it's going to be on NTES, as Rob analyzed earlier in the session. Looking at a target price of 115, if I remember correctly. Is that right, Rob?
That's correct.
All right. And the time frame on that?
Just stay with the standard 3 months.
3 months. All right. So as you can see, we have these fixed intervals of time here on the time frame. So we will go to a quarter out or 3 months. We will come back and make this very pretty here in just a moment after this session. But for now, I'm going to go ahead and get this posted. That way you can come in and interact. And whether you agree or disagree, we welcome your opinion. As again, you can see it's posted here and available for you to share your thoughts on this overall case study consideration and idea for the week. Differing opinions is what makes markets. So if you disagree, please feel encouraged to share why. And if you agree, then please feel free to agree with the idea. So I think that sums up the post for this week, and I'll pass it back to you, Rob, to add any concluding thoughts.
Okay, I thought I would just bring the screen back and show you real quickly once again what the chart looks like. Looks pretty solid, adding in the DMI. So we'll see if this one plays out as well as the last couple have. Again, high score, but there's no guarantees. We'll see how it plays out. Good to be back with you again after being off last week, and now we're caught up to what's going on in the market. We'll wait and see what news events we get from here and how the market handles the potential of moving back above the current area of resistance or back down towards the point of the triangle. So little in between action going on here with the S&P. So thanks as always for watching. Appreciate your time during the trading day. Get back to the trading day. Have a great rest of your day and look forward to talking again soon.